In today's episode, we'll break down two important stories. First, we'll talk about a little boy coming for India's monsoons, and then we'll talk about the uncertainty behind India's car emission rules. Welcome back to the Daily Brief by Zerodha, where we cut through the noise to help you understand what's actually happening in the most important stories from business and markets. If you're listening to this on your commute, on a walk, or at the gym, you can also find the Daily Brief as an audio podcast on Spotify, Apple Podcasts, or wherever you listen to your podcasts. I'm your host Akshara, and today is Monday, 23rd March. Coming to the first story. So this month, America's National Oceanic and Atmospheric Administration issued an El Niño watch. It's a formal signal that conditions are becoming favorable for El Niño, the climate phenomenon, to develop. The opposite, La Niña, which gave India an above-normal monsoon in 2025, is fading. By August, there's a 62% probability that El Niño conditions will be underway. Now, El Niño is far from being a distant weather phenomenon for anyone, including India. It disrupts the southwest monsoon winds that Indian rains depend on, and that, in turn, increases the occurrence of heat waves, depressing agricultural output, lifting food prices, and straining the power grid. Its impact on the Indian economy is almost decisively negative. But interestingly, El Niño isn't negative everywhere. It also creates winners, including, counterintuitively, parts of India's own power sector. And the effects that originate thousands of kilometers away in the copper mines of Chile and the soybean fields of Argentina eventually wash up on Indian shores through changes in the prices of imports. Let's dive in. So in English, El Niño literally translates as the little boy. But boy, oh boy, in no way is it little as far as its climatic impact is concerned. And for that, let's take a little lesson on oceanography. See, in a normal scenario, strong winds push warm water towards Asia, keeping the eastern Pacific near North and South America relatively cool. This huge movement of water splits the world into two halves of the Pacific Ocean. On one side, you have the Western Pacific, the warm pool in the Asia-Pacific region. Eventually, the warmth makes the water evaporate into moisture, which turns into the expected rain of the July-September season by countries like Indonesia, Sri Lanka, and India. These are also countries that, by virtue of their closeness to the equator, generally receive a lot more heat anyway. Meanwhile, the region around the Americas, the Eastern Pacific, remains cool and dry, almost autumn-like. But when the little boy arrives, it plays spoilsport to this whole thing. In El Niño, every few years, this wind movement weakens. The warm water sloshes back east and sea surface temperatures in the central and eastern Pacific Ocean rise abnormally, sometimes by 1 degree Celsius, sometimes by 2 to 3 degrees Celsius in a strong event. Around 26 El Niño events have been recorded since 1950. Instead, you now have rains around the Americas, while most of South and Southeast Asia experiences dry heat waves. The drought zones are mostly concentrated in the Asia Pacific. India, Australia, Indonesia all receive below normal rainfall. Meanwhile, the Atlantic basin calms down and areas like California, the American Southeast, and Argentina receive rainfall they would not otherwise get. La Niña is the other extreme of this. Here, the moisture around the Asia-Pacific region becomes so warm that it creates excessive rainfall. So India experiences abnormal levels of heat and humidity in this case, and our recent stretch of above normal monsoons was La Niña influenced and have even caused overflowing in many cases. Now, what you shouldn't be mistaking them for is climate change. Both these phenomena are simply the function of the physics of heat flows. However, while climate change may not be their cause, it could be a catalyst that could amplify their effects further. Now, for India, the most immediately quantifiable impact of El Niño is on the electricity grid. The 2023-24 El Niño event contributed directly to what became the hottest year on record for India, with average temperatures 0.65 degrees Celsius above the 1991 to 2020 baseline. Delhi's Mungeshpur area, for instance, hit an unprecedented 52.9 degrees Celsius. Temperatures that extreme will require ACs and coolers running at full capacity across millions of homes and offices for weeks at a stretch, and that is more power. Now, India's peak power demand has been climbing fast. It stood at 154 gigawatt in 2015, but by 2024, it had reached 246 gigawatt, a 59% surge in under a decade. The government is already projecting 270 gigawatt for this summer, an 8% jump over the all-time high. During the peak heatwave months of April to June 2024, electricity demand ran 10.8% higher than the same period the year before, with ACs accounting for almost a third of that year on year increase in May alone. El Nino impacts our power demand through two simultaneous mechanisms. On the demand side, hotter summers drive more cooling load. And on the supply side, a weaker monsoon drains the reservoirs and river catchments that hydroelectric plants depend on. During the first half of 2024, hydro generation fell 8% year on year as the lingering effects of the 2023-24 El Nino starved catchment areas of rainfall. Coal stepped in as coal fired generation rose 10% in H1 2024 and gas fired output jumped 50%. El Nino's impact on our energy mix is indubitably one sided. It increases our power demand while also forcing us to be more reliant on non renewables like coal and even oil and gas. But in recent times, solar complicates the story a little. How so? A suppressed monsoon means fewer clouds over India's major solar generating states Gujarat, Rajasthan, Maharashtra. During the above normal 2025 monsoon, solar irradiance actually fell 3 to 10% in those regions compared to long term averages. But in an El Nino year, you would have a surplus of energy from the sun being out almost all day. In La Nina years, the dynamics reverse. FY 2024-25 saw coal generation growth at its slowest since COVID, just 2.8%, because better hydro output and renewable growth absorbed most of the base load increase. La Nina dampens the thermal sector's windfall, while El Nino hands it one. Now, beyond the power grid, India's agricultural output takes a severe hit under El Nino. Historical data from ICRIER going back to 1951 shows that 11 of 15 moderate to severe El Nino years resulted in a contraction of India's agricultural output with an average 9.7% drop in monsoon rainfall and a 5.7% fall in kharif food grain production. Now, El Nino's economic reach extends well beyond India's monsoon. It's a powerful shaper of agricultural output and commodity prices globally, and some of those distant reshufflings eventually arrive in India through what it imports. We'll mostly divide the effects into regions experiencing drought due to El Nino and regions that get high rainfall due to it. So, the broad pattern in drought affected regions is consistent with what we see in India weaker harvests leading to higher food prices, lower hydroelectric output, and greater reliance on fossil fuels. An analysis of El Nino events from the 1970s onward found that global food commodity prices rise by around 5% in an average El Nino year, with the effect lasting 6 to 16 months. And the food is often the strongest driver of inflation. Energy prices also climb as the same hydro deficit that hits India's grid hits grids everywhere else, and coal and crude fill the gap. Now, for India, rising global food prices land with unusual force on our imports. Food makes up close to half of India's CPI basket, far higher than in advanced economies and comparable only to other large developing nations like Indonesia and Thailand. When palm oil, which India mostly imports from Indonesia, gets pricier because drought has hit Sumatra, Indian consumers feel it almost immediately. Indonesia's mining sector is also a victim of the drought El Nino brings to it. Now, Indonesia is the world's largest nickel producer, and its mining depends heavily on hydropower. When river levels drop, power output falls, and nickel production gets curtailed, which pushes its prices up. India has little nickel of its own, and in such a situation, we are at the mercy of higher nickel import prices. However, the high rainfall situations create a different set of economic effects, some obvious, some less so. In the US, El Nino brings welcome rains to drought prone California, benefiting water intensive crops like almonds, avocados, and limes. The east coast of the US also sees fewer hurricanes compared to the normal situation. The IMF found that the US is one of the few large economies that typically sees positive GDP effects from El Nino, largely through these agricultural and storm season channels. Even Argentina benefits from the same moisture redistribution, with heavier rains driving a bumper soybean harvest. Argentina exports approximately 95% of the soybean it produces, so a bigger harvest keeps global soybean prices lower than they would otherwise be. That's a genuine benefit that even India, a major importer of soybean oil, takes advantage of. But high rainfall isn't always a blessing. In some cases, it can completely halt economic activity. For instance, El Nino brings heavy rainfall to Chile's normally dry, desert-heavy and mountainous regions. These are also areas where the country's largest copper deposits sit. But as the mountain roads flood, mines become difficult to access and even shut down. As a result, global copper prices rise, and in almost every way, this is an inversion of what Indonesia's mining sector goes through. Now, India doesn't have many copper reserves of its own, and it needs copper for cables and transformers. This, of course, inflates our import bill only further. Now, on balance, the little boy is bad news for India. The agricultural hit flows through a predictable chain, and since food makes up close to half of India's CPI, that chain runs fast and deep. And the global commodity effects compound it through import channels that have little to do with our domestic conditions. Historically, one counteracting force to the El Nino has been another phenomenon called the Indian Ocean Dipole, or IOD. Unlike El Nino, which acts across the world through the Pacific Ocean, the IOD only acts on the regions around the Indian Ocean. Now, we won't go into detail on how it works, but what you should know is that a positive IOD signals positive Indian monsoons, while a negative IOD will amplify El Nino's drought like conditions. For what it's worth, we can't be fully dependent on the IOD to neutralize El Nino. Now, what moderates the agricultural damage and has done so increasingly over the decades is irrigation. In 1965, a drought with an 18.2% monsoon deficit caused food grain production to fall 19%. But in 2025, a nearly identical 13.8% deficit caused only a 0.2% fall. The difference was irrigation cover expanding from 21% to 53% over those 50 years. India has learned to absorb El Nino's agricultural punch far better than it once did. As for power, it makes us more reliant on non renewables, dampening hydropower on one end while increasing coal and oil usage. However, there is a possibility that this might change with our solar build out. Now, these aren't forces that are caused by the extremities of climate change, but climate change has made them more unpredictable and often more negative in impact. The question for 2026 then is how far our resilience extends. For all the sources mentioned in this video, don't forget to check out our newsletter. The link is in the description. Coming to the second story. On the morning of February 10th, 2026, executives from India's major car companies walked into a meeting at the Ministry of Heavy Industries, expecting to finish a conversation they thought was nearly done. The Bureau of Energy Efficiency, or BEE, had been consulting the industry for over a year on the next phase of India's corporate average fuel efficiency, or CAFE, rules. The executives had studied the draft, made their positions clear, and were ready to move to a final notification. Instead, BEE presented a version of the rules that none of them had seen before. SIAM later wrote to BEE, formally noting that this was the third materially different proposal in under 2 years, shown to members for the first time at that meeting. The rules that are supposed to govern India's car industry from April 2027, now just over a year away, still don't exist in final form. Let's start with what the CAFE norms do. Now, if you make cars in India, the government doesn't look at how efficiently any single model is. It looks at a manufacturer's entire fleet, calculates a weighted average carbon dioxide emission level across all of it, and checks whether that average stays below a prescribed ceiling. So, for instance, if you sell a lot of heavy SUVs, which are considered more polluting, you might need to offset them with cleaner cars, like EVs, hybrids, small petrol hatchbacks. Fall short and you pay penalties under the Energy Conservation Act. In practice, the heavier your fleet, the harder compliance tends to be. Now, India has already done 2 rounds of this. CAFE 1 from 2017 set a fleet average cap of 130 grams of carbon dioxide per kilometer. CAFE 2 from 2022 tightened that to 113 grams. CAFE 3, which was drafted in September 2025 and is expected to run from April 2027 through March 2032, may tighten it further still. Now, the September 2025 draft sets each manufacturer's allowed average using a formula that links to the average weight of their fleet. Heavier fleets got a slightly more lenient ceiling, while lighter fleets face one that's more demanding. Manufacturers can also pool their fleets with other manufacturers and be treated as a single entity. Now, the reason BEE has been confident enough to keep tightening its proposals is the compliance data it's collected under CAFE 2. For instance, Tata Motors passenger vehicles recorded fleet emissions of 95.1 grams per kilometer in FY24 against a permitted target of 119.7 grams, a cushion of over 24 grams driven by its EV and CNG heavy portfolio. Maruti Suzuki came in at 103.6 grams against a target of 109.2 grams. Now, BEE's conclusion from the data was that the gap between targets and actual emissions has been widening across the industry, and to them, that suggested the industry can handle tougher standards. That's where the conflict between SIAM and BEE begins. But even before that, the September 2025 draft had already divided the industry. Now, the provision that consumed most of the public debate is a single paragraph in the September 2025 draft, which reads, considering the limited potential for efficiency improvements in petrol vehicle models with an unladen mass up to 909 kg, engine capacity not exceeding 1200 cc, and length not exceeding 4000 millimeters, said motor vehicle model shall be eligible to claim a further reduction of 3 grams of carbon dioxide per kilometer in its manufacturer declared carbon dioxide performance. What that means is a small, light petrol hatchback would effectively get a compliance advantage, treated as emitting less than it actually does. And Maruti Suzuki controls roughly 95% of this specific segment. At the formal SIAM vote on November 7th, 15 companies voted against the exemption and only 4 firms supported it: Maruti, Renault, Tokyo Kirloskar, and Honda. Most of the industry argued that such a provision benefiting just 4 firms isn't a public interest measure. Moreover, they said that incentivizing lighter cars risked reversing India's safety progress since no car currently under 909 kg carries a Bharat NCAP rating. Meanwhile, of those 15, Tata didn't oppose stricter CAFE norms. However, they didn't think that petrol based cars in particular should get such exemptions. Rather, emissions should be curbed through the use of green technologies like EVs and CNG, which Tata has a healthy portfolio of compared to the competition. Moreover, they also argued that by virtue of the new CAFE formula, lower weight cars can already get an advantage. However, the 4 firms who supported the proposal make up 63% of India's passenger vehicle production, which mostly includes small, affordable cars bought by the Indian middle class. Maruti aggressively pushed for the exemption, and in fact, in the first CAFE 3 draft released in June 2024, Maruti was frustrated with the lack of any meaningful exemption for small cars. We covered Maruti's side of this argument in depth in a previous Who Said What episode. Now, BEE published the first CAFE 3 draft in June 2024, and in September 2025 came the substantially revised second draft with a 909 kg exemption. By December, JSW, MG Motor, Tata Motors, and Kia had written directly to the PMO opposing the carve out. The SIAM vote left the industry body unable to present a unified position, and by January 2026, Toyota Kirloskar was publicly asking the government to issue a clear, final notification soon so the industry could plan. Then came February 10th. BEE's third draft dropped the 909 kg exemption but introduced annual tightening targets. The industry wide emission ceiling fell from 92.5 grams per kilometer in FY28 to 77.08 grams per kilometer by FY32 versus the 113 grams under CAFE 2 today. And BEE suggested reducing the limit every year. SIAM's email to BEE on February 19th set out the frustration plainly. Significant variations from previous versions seen for the first time at that meeting. The industry body called for a single target of 89.6 grams per kg for the entire 5-year period, the same block structure used under CAFE 1 and CAFE 2. Even Tata, the most vocal in favor of tougher targets, said through a spokesperson that annual tightening could be challenging and supported SIAM's call for a clearly defined CAFE 3 target. At Mahindra's Q3 FY26 analyst meet, an analyst asked the CEO whether the proposed norms were achievable given Mahindra's current EV portfolio. His answer, okay, let me take the question on which there's no answer, which is CAFE. It wasn't an evasion, but rather a reflection of how hard it is to plan billion-rupee investment decisions against non-stop policy flip-flops. In March, the government shared an internal compliance assessment for the first time at that meeting. Tata was projected to meet CAFE 3 targets consistently. However, Maruti and Hyundai were expected to be struggling. Meanwhile, Mahindra expected to miss targets in the first 3 years. The same report said the government is now considering pushing back the April 2027 start date entirely. Now, BEE's data shows every major car maker has been meeting CAFE2 targets with a growing cushion. Evidence: BEE argues that the industry can handle tougher standards. But the PMO's own internal assessment shows that at least three major manufacturers may be unable to comply under the current CAFE3 framework. Both things are true simultaneously and they don't resolve cleanly against each other. After all, CAFE2 is a standard the industry adapted to over years, while the February 2026 proposal is a step change that the data suggests several manufacturers genuinely aren't ready for. The whole point of a tightening standard is to push companies toward investments they wouldn't otherwise prioritize. But there's a difference between a standard that stretches an industry and one the industry can't plan toward because it keeps changing. Powertrain decisions get made 3 to 5 years before a car reaches the market. By the time the rules are finalized, many of those decisions are already locked in. If the target formula is still being negotiated just over a year before the regulation is supposed to kick in, those decisions have already been made in a vacuum. The industry isn't asking for the standard to disappear. It's asking for certainty about what the standard will say. And that's not an unreasonable ask. But what's clear is that, let alone the government and industry conflicting, the industry itself is fragmented on what CAFE3 should look like. And it won't be easy to get alignment on what the standard should be. Now, coming to the tidbits. The government launched a relief scheme for exporters hit by the Middle East conflict. With the Iran war disrupting shipping routes, pushing up freight and insurance costs, and closing key Middle Eastern markets, the government has rolled out a scheme called Relief to support affected exporters. Details are still emerging, but it's expected to include credit guarantees for small businesses and targeted support for sectors like textiles and gems and jewelry. Coming to the next tidbit. The rupee slid to 92.94 against the US dollar on Friday, a new all time low. The culprit is the same as it's been all month: surging crude oil prices from the Iran war, persistent FII outflows, and a hawkish Fed that held rates steady this week. The RBI has been intervening to prevent a sharper slide, but with Brent crude still hovering around $107 a barrel, the pressure isn't going away. Coming to the final tidbit. SBI Funds Management has filed a DRHP with SEBI for an IPO, which is entirely an offer for sale. SBI will offload 12.83 crore shares, a 6.3% stake, and French partner Amundi will sell 7.54 crore shares, 3.7%, for a combined 10% dilution. No fresh shares will be issued. Market sources peg the issue size at roughly rupees 12,500 crore, which would value the company at around rupees 1 lakh crore. SBI Funds manages over rupees 16 lakh crore in AUM and commands an approximately 15.5% market share. That's all the news I have for you. Thank you so much for watching and see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.